$344 billion in cash. That's more than Apple, Microsoft, Google, Amazon, and Nvidia combined. Despite those 5 companies being worth 14 times more than Berkshire Hathaway. Warren Buffett, the man who made $140 billion betting on stocks, just walked away from the market. He sold 67% of his Apple position, $104 billion worth. He dumped 23% of Bank of America. 28% of Berkshire is now cash, the largest pile in the company's history. He's done this twice before. Both times, a crash followed within 18 months. This is the 3rd time. But here's what nobody is talking about. The real reason isn't fear of a crash. It's something far more calculated. In his latest shareholder letter, Buffett wrote something that should terrify every investor. We cannot find companies where we can deploy $10 to $30 billion with confidence. The greatest investor in history can't find anything worth buying. By the end of this video, you'll see exactly what Buffett sees, and you'll understand why the clock is ticking. Let's start with his own words. At the May 3rd, 2025 annual meeting, a journalist asked him point blank, "You're holding record cash. Are you worried about a crash?" Buffett's answer was brutal. "I don't time the market. I don't know if it'll crash tomorrow or in 2 years, but I do know that when the price to earnings ratio of the entire market is above 22 times and the historical norm is 15.5 times, prices are pricing in way too much optimism. I don't pay for optimism, I pay for assets. That's the foundation. Buffett operates on math, and the math right now says the market is insanely expensive." Let's go deeper, because this is where it gets really dark. Buffett has always used one simple metric to value the entire stock market. It's called the Buffett Indicator. Take the total market capitalization of all US stocks divided by GDP. Right now, it's at 219%. That's double the healthy range. The last time it hit this level, March 2000. You know what happened next? The Nasdaq collapsed 78%. Here's the kicker. Every single time this indicator crossed 200%, the market crashed within 2 years. Every single time. The market is worth more than double what the entire US economy produces in a year. Investors are paying for future growth that may never happen, and Buffett knows it. At the annual meeting, Buffett also addressed corporate taxes. He said something that shocked a lot of people. Quote, "Current corporate tax rates are historically low. I'm locking in gains now because I believe taxes will rise." Let that sink in. Buffett, who has spent his entire life minimizing taxes legally, is willingly paying billions now because he knows rates are about to explode. When the guy who wrote the playbook on tax efficiency tells you to lock in gains, you listen. US national debt just exceeded GDP for the first time since World War II. $35 trillion. The government is now spending more on interest payments than on defense. That's never happened before, and it only ends 2 ways: raise taxes or inflate the debt away. Buffett is betting on both. He's paying 21% tax now rather than 30 or 35% in a few years. That's not pessimism, that's calculation. He's planning for a multi-year bear market where taxes and inflation both rise. He's not just avoiding a crash, he's positioning for a decade of pain. Let's talk about Apple. Buffett's sale of 67% of his Apple stake shocked the market. Berkshire went from owning $174 billion of Apple to $70 billion. A $104 billion sale, the largest stock sale in Berkshire's history. And here's the key. Buffett loves Apple. He's called it one of the best businesses in the world. He's praised Tim Cook. He's talked about Apple's brand loyalty, its ecosystem, its margins. So why sell? Because even great companies can be overpriced. At the time of the sale, Apple's price to earnings ratio was around 30 times. For a company growing revenue at 5 to 7% annually, 30 times earnings for mid-single digit growth is expensive. Historically, Apple traded at 15 to 20 times earnings. Buffett didn't sell because Apple got worse. He sold because the price got stupid. Selling Apple wasn't a vote against Apple. It was a vote against the price. Buffett said it himself at the meeting, "I love Apple, but not at a price that assumes they'll grow forever." That's discipline. Most investors fall in love with a stock and refuse to sell even when it's clearly overpriced. Buffett doesn't have that problem, and that's why he wins. But Apple wasn't the only thing he sold, and what he bought instead reveals his entire endgame. Hold on, because this gets darker. After the 2008 financial crisis, the Fed printed $9 trillion. Then COVID hit, another $4 trillion. All that money had to go somewhere, and it went into stocks, real estate, crypto, everything. The result, the biggest everything bubble in history, and Buffett sees it. But here's the genius move nobody is talking about. Buffett isn't just holding cash in a checking account. He's holding it in short-term treasury bills, 3-month and 6-month T-bills. They pay about 5% interest with zero risk. That $344 billion generates roughly $17 billion in interest annually, risk-free. And here's the kicker. If inflation stays elevated and the Fed keeps rates high, those T-bills keep paying. If the market crashes and the Fed cuts rates to save the economy, Buffett has $344 billion in dry powder to buy assets at half price. It's a perfect hedge. He wins either way. If the market keeps going up, he collects 5% and waits. If the market crashes, he deploys and makes 50 to 100% returns buying panic sale assets. Cash isn't a liability. It's an option on the future, and Buffett just bought the biggest option in history. Now here's where this gets really dark, because Buffett isn't the only one preparing for war. Let's talk about concentration risk, because this is a huge part of why Buffett is worried. Right now, the top 10 stocks in the S&P 500 make up over 30% of the entire index. That's the highest concentration in history. Apple, Microsoft, Nvidia, Amazon, Google, Meta, Tesla. these 7 companies dominate. If they fall, the whole market falls. And here's the problem. Most of these companies trade at extreme valuations. Nvidia at 50 times earnings, Tesla at 60 times, Amazon at 40 times. They're priced for perfection. Any disappointment in earnings, any slowdown in growth, any regulatory crackdown, and they could drop 30 to 50%. And when they drop, they'll drag the entire market down with them. Buffett sees this. That's why he's reducing his exposure to megacap tech. He doesn't want to be holding the bag when the music stops, and the music always stops. Here's where this gets even more chilling. At the May annual meeting, Buffett was asked about artificial intelligence. Everyone expected him to be skeptical. Instead, he said something that should haunt you. Quote, even Sam Altman, the CEO of OpenAI, called this an AI bubble. When the person making the most money from AI says it's a bubble, I listen. Let that sink in. The guy building ChatGPT admits it's a bubble. And yet Nvidia, the chip company powering AI, has a market cap over $3 trillion. Microsoft is betting everything on AI. Google, Amazon, Meta, all going all in. Billions in capital expenditures. And for what? Most AI applications don't generate profit yet. They're subsidized, the technology is incredible, but the business models are unproven. Buffett lived through the dot-com bubble, the internet was real, the technology was transformative, but that didn't stop thousands of companies from going bankrupt because they had no path to profitability. He's seeing the same pattern now. The technology is real, but the valuations are insane, and when reality catches up, it's gonna be ugly. So what is Buffett waiting for? He's been very clear. At the annual meeting, he laid out his criteria. He's waiting for the market cap to GDP ratio to fall below 150%. Right now it's 219%. That means he's waiting for a 30 to 40% correction. He's waiting for the S&P 500's price to earnings ratio to fall below 18 times. Right now it's 22 times. He's waiting for quality companies to trade at reasonable valuations. Companies with low debt, high cash flow, strong competitive advantages. Right now those companies are expensive, but in a bear market they get cheap. And that's when Buffett pounces. He's done it twice before, and he's about to do it again. The question isn't if, the question is when. And based on historical patterns, the answer is soon, very soon. But that's not the scariest part. Let me show you what happened the last 3 times Buffett did this. Let's go back to 1974. Buffett had been building cash for over a year while the market was crashing. Stocks had fallen nearly 50% from their peak. Investors were terrified. Inflation was soaring. Oil prices had quadrupled. The economy was in recession. Everyone thought stocks would keep falling, but Buffett saw value. He bought the Washington Post for a fraction of its intrinsic worth. He bought stocks across the board. Companies with strong businesses trading at absurd discounts. Over the next decade, those investments multiplied many times over. Fast forward to 2000, Buffett had been holding massive cash reserves since 1998. The dot-com bubble was in full swing. Companies with no profits and barely any revenue were going public and doubling on day one. Analysts mocked Buffett, saying he didn't understand technology. His performance lagged the market for 3 straight years. Then March 2000 came. The bubble popped. The Nasdaq fell 78% over the next 2 years. Thousands of companies went bankrupt. Trillions of dollars in wealth evaporated. And Buffett deployed his cash. He bought quality companies at deep discounts. Berkshire massively outperformed for the next decade. Then 2007, Buffett was accumulating cash again. Banks were leveraged 30 to 1. Subprime mortgages were being packaged into derivatives and sold worldwide. The housing market was in a frenzy. Everyone said housing prices never go down. Buffett stayed cautious. He held $40 billion in cash. Then September 2008, Lehman Brothers collapsed. The entire financial system nearly imploded. The S&P 500 dropped 57% in 18 months. Credit markets froze, unemployment spiked, and Buffett had his moment. He bought $5 billion of Goldman Sachs preferred shares at 10% interest. He bought $3 billion of General Electric. He bought billions of Bank of America warrants that later turned into a $30 billion profit. The pattern is undeniable. Buffett accumulates cash when the market is expensive. Everyone mocks him for underperforming. Then the market crashes, and he deploys his cash at the bottom, making generational returns. That's what's happening right now. He's holding $344 billion. People are saying he's too old, too cautious, missing the rally. But history shows he's right. The crash hasn't happened yet, but it's coming. And when it does, Buffett will be ready. The question is, will you? And here's what scares me. Both times, the crash came faster than anyone expected. 2000 bubble, 6 months from peak to panic. 2008, 4 months from Lehman to capitulation. This time, with algorithmic trading and leveraged ETFs, it could be even faster. Here's something that should concern you. The last 2 major bear markets, 2000 and 2008, both had warning signs that most people ignored. In 2000, it was insane valuations on tech stocks, companies trading at 100 times revenue with no profits. In 2008, it was excessive leverage in the financial system, banks with 30 to 1 debt ratios. Both times, experts said everything was fine. Both times, the market kept going up right until the moment it collapsed. And both times, the people who listened to the warnings and protected their capital were labeled pessimists and fearmongers until they were proven right. Right now, we have both warning signs at the same time. Insane valuations on tech stocks and AI companies, and massive debt across the entire economy. Corporate debt, government debt, consumer debt, all at record highs. The system is more fragile than it's ever been, and Buffett knows it. That's why he's not just selling stocks. He's building the largest defensive position in his career. $344 billion is not a normal cash position, it's a fortress, and fortresses get built when war is coming. Here's what most people miss. Buffett's cash position isn't just about avoiding losses, it's about maximizing future gains. If you lose 50% of your capital in a crash, you need a 100% gain just to get back to even. That's brutal math, but if you're sitting in cash and the market drops 50%, you can buy at half price and double your money when it recovers. The difference between losing 50% and gaining 100% is enormous. Buffett understands this better than anyone. He said it repeatedly. Rule number 1, never lose money. Rule number 2, never forget rule number 1. Holding cash during a bubble isn't about being scared, it's about being smart, and the payoff comes later, when everyone else is panicking and you're the only one with capital to deploy, and he's not the only one stacking cash right now. Let me tell you about the one purchase Buffett made this year that reveals his entire strategy. In August 2025, Berkshire bought $9.7 billion of Chubb, a property and casualty insurance company. It was the largest purchase Berkshire had made in 3 years. Most analysts were confused. Why buy an insurance company when the market is at all-time highs? Because Buffett understands something most people don't. Insurance companies generate what's called float. Policyholders pay premiums up front, and the insurance company invests that money while waiting to pay out claims. It's essentially a zero-interest loan. When the crash comes, Buffett will have nearly $500 billion ready to deploy. That's more than the GDP of Norway. And he'll use it to buy blue-chip companies at 50 cents on the dollar while everyone else is liquidating just to survive. That's not investing, that's warfare. That's exactly what he did in 2008. He used Berkshire's insurance float to write $5 billion checks to Goldman Sachs and GE within days of the crash. Most investors couldn't get loans. Banks were frozen, but Buffett had the capital ready to go. The Chubb purchase tells you he's preparing for the same scenario. He's building up his float, stacking dry powder, getting ready to deploy when the crash comes. Berkshire owns Geico, General Ray, Berkshire Hathaway Reinsurance Group. Combined, these insurance operations hold over $150 billion in float. That's $150 billion Buffett can invest without risking his own capital. When the market crashes and everything goes on sale, Buffett will have nearly $500 billion between his cash reserves and insurance float. That's more capital than anyone else in the world. The strategy is already in motion, but let's be honest, you're not worried Buffett is wrong. You're worried about what happens when he's right. So let me tell you what you should actually do with this information, because knowing what Buffett is doing is useless if you don't act on it. First, understand that you are not Warren Buffett. You don't have $344 billion. You don't have access to private deals. You don't have an insurance empire generating float, so you can't just copy his strategy exactly, but you can apply the principles. Stop chasing, build cash 20, maybe 30%. Focus on companies that actually make money, not growth stories. And wait, that's it. Boring? Maybe. But boring keeps you alive when the market implodes. Reduce exposure to overvalued tech stocks. Anything trading above 30 times earnings with single-digit growth. Trim or sell. Increase your cash position to at least 20%, maybe more if you're close to retirement. Focus on dividend-paying blue chips with strong balance sheets. Companies that can survive a recession, utilities, healthcare, consumer staples. Avoid high-growth, unprofitable companies. The ones that only work in a zero-interest rate environment. When rates are high and liquidity is tight, those companies get crushed. And buy some insurance, gold, treasury bills, maybe even some put options if you're sophisticated enough. Something that goes up when the market goes down. That's a balanced approach. You're not going all in on cash like Buffett, but you're also not fully exposed to an overvalued market. You're protecting your downside while staying positioned for the upside. Or you can ignore this. Keep buying. Hope Buffett is wrong, but ask yourself, when was the last time betting against Warren Buffett worked out? Let's address the elephant in the room. What if Buffett is wrong? What if the market doesn't crash? What if we're entering a new era where valuations stay high forever? Here's the honest answer. It's possible. Anything is possible, but history says it's unlikely. Every single time the market has been this overvalued, it has corrected. Sometimes by 20%, sometimes by 50%, but it always corrects. The laws of economics don't change. Companies can't trade at infinite multiples forever. Growth slows, earnings disappoint, interest rates rise, liquidity dries up, and when those things happen, the market falls. Buffett has lived through 10 major bear markets. He's seen this pattern repeat over and over, and he's betting his reputation that it happens again. Could he be wrong? Sure, but I wouldn't bet against him. His track record speaks for itself. Here's the part that most people don't talk about. Even if the market keeps going up for another year, Buffett will be fine. His cash is sitting in treasury bills earning 5%. That's $17 billion a year in risk-free interest. Meanwhile, Berkshire still owns $70 billion of Apple, $50 billion of Bank of America, $30 billion of American Express, and dozens of wholly owned businesses generating tens of billions in cash flow annually. Buffett isn't sitting on the sidelines. He's just not overexposed. If the market goes up another 20%, Berkshire will participate through its existing holdings. If the market crashes 50%, Berkshire will lose far less than everyone else and then deploy its cash at the bottom. Heads, he wins. Tails, he wins more. That's the beauty of his strategy. He's positioned to win in any scenario. The only way he loses is if stocks go up forever and never correct. And anyone who believes that doesn't understand markets. Let me show you one final piece that ties this all together. In 1929, the market market was at all-time highs, valuations were extreme, leverage was rampant, everyone was making money, and a few investors, the smart ones, started pulling out. They were mocked, called pessimists, told they were missing the greatest bull market in history. Then October 1929 came. The market crashed. It fell 89% over the next 3 years. Thousands of investors were wiped out. Banks failed. The economy collapsed. But the investors who had sold and held cash, they survived. And more importantly, they bought assets at 10 cents on the dollar during the Great Depression and became generationally wealthy. The lesson is simple. When everyone is euphoric and stocks are expensive, be cautious. When everyone is panicking and stocks are cheap, be greedy. Buffett has built his entire fortune on this principle, and right now he's being cautious, very, very cautious. That should tell you everything you need to know. Right now, insider selling is at levels we haven't seen since 2007. Corporate executives, the people who know their companies best, are dumping stock at a furious pace. Jeff Bezos sold over $8 billion worth of Amazon shares this year. Mark Zuckerberg has been selling Meta stock every single month. Executives at Nvidia, Microsoft, Tesla, all selling. These aren't small sales, these are massive liquidations. When insiders sell, retail investors usually shrug it off. They say insiders sell for lots of reasons. Diversification, taxes, buying a house, whatever. And that's true. But when you see coordinated selling across multiple industries, across dozens of executives all at the same time, that's a signal. These people have access to information you and I don't have. They see the internal numbers, they know what's coming, and they're getting out. Meanwhile, retail investors are buying. The dumb money is rushing in while the smart money exits. That's how tops are made, every single time. And Buffett, the ultimate insider, is doing the exact same thing. He's selling while everyone else buys. That should tell you everything you need to know. Now let's talk about what Wall Street isn't telling you. The big investment banks, Goldman Sachs, Morgan Stanley, JP Morgan, they're all telling clients to stay invested. They're issuing bullish price targets on the S&P 500, 6,000, 6,500, some even saying 7,000. But here's the dirty secret. These banks make money when you trade. They collect fees on every transaction. They underwrite stock offerings. They manage mutual funds and ETFs that charge annual fees based on assets under management. If everyone pulls their money out and sits in cash, those fees disappear. The banks lose billions, so they have a vested interest in keeping you invested even when the market is overvalued. Buffett doesn't have that conflict. Berkshire Hathaway doesn't charge management fees. Buffett makes money when the stock price goes up and he loses money when it goes down. His incentives are aligned with shareholders. So when he sells, he's not doing it to generate fees or keep assets under management. He's doing it because he genuinely believes stocks are too expensive. That's the difference between Buffett and Wall Street. Wall Street needs you to stay in the market. Buffett doesn't, and that's why you should listen to him, not them. Here's a question that's been bothering me. If the market is so overvalued, why hasn't it crashed yet? Why does it keep grinding higher? The answer is liquidity. Central banks around the world are still pumping money into the system. The Federal Reserve's balance sheet is still massive. The European Central Bank, the Bank of Japan, the People's Bank of China, they're all printing money or keeping rates artificially low. That liquidity has to go somewhere, and a lot of it flows into stocks. As long as liquidity keeps coming, the market can stay irrational longer than you can stay solvent. That's the Keynes quote everyone forgets. But here's the thing, liquidity doesn't last forever. Eventually, central banks have to tighten. Inflation forces their hand, or debt becomes unsustainable, or something breaks in the financial system, and when liquidity dries up, the market collapses fast. We saw it in 2008. Lehman Brothers failed, liquidity froze, and the S&P dropped 57% in 18 months. We saw it in 2000. The Fed raised rates, the dot-com bubble popped, and the Nasdaq fell 78%. The pattern is always the same. Liquidity creates the bubble, tightening pops it, and right now we're in the late stages of the biggest liquidity-driven bubble in history. Buffett knows this. That's why he's holding cash. He's waiting for the liquidity to drain and the market to collapse. And when it does, he'll have $344 billion ready to deploy. Let me give you another piece of the puzzle. Buffett has always said that his favorite holding period is forever. He loves buying great businesses and never selling. Coca-Cola, American Express, these are stocks he's held for decades. So when he sells, it means something. And he's not just selling Apple. He's been trimming positions across the board. Bank of America, down 23%. He's reduced holdings in several other financials. He's letting positions expire rather than rolling them over. This is a systematic de-risking of the entire portfolio. Buffett is preparing for a bear market. And he's doing it methodically, quietly, without causing panic. Most investors don't even realize what's happening. They see Berkshire's stock price holding up and assume everything is fine. But under the hood, Buffett is liquidating. He's moving to cash. And he's doing it because he knows what's coming. In his shareholder letter, Buffett wrote something that haunts me. Quote, "Despite what some commentators consider our excessive cash, the great majority of your funds remain in equities. We will forever be investing the bulk of our assets in stocks, predominantly American. Berkshire will never prefer cash to owning a good business, but paper money can be devalued if fiscal madness prevails." Read that last sentence again. Paper money can be devalued if fiscal madness prevails. That's a warning. He's telling shareholders that the dollar could lose value if the government keeps printing money. And if that happens, cash becomes less valuable, but so so do stocks, because earnings get denominated in a weaker currency. The only real hedge in that scenario is hard assets: gold, real estate, commodities. Buffett has always been skeptical of gold, but even he's acknowledging that if the government goes full fiscal madness, all financial assets are at risk. That's terrifying coming from someone who's spent 70 years betting on America. Here's where we are. Buffett is sitting on $344 billion in cash. The market cap to GDP ratio is 219%, the highest in 78 years. The price to earnings ratio of the S&P 500 is 22 times, well above the historical average. Corporate debt is at record levels. Government debt exceeds GDP. The top 10 stocks make up over 30% of the index, creating massive concentration risk. Insider selling is at levels not seen since 2007. Buffett has sold 67% of his Apple position and 23% of Bank of America. He's done this twice before, in 2000 and 2008. Both times, a crash followed within 18 months. Both times, he deployed his cash at the bottom and made generational returns. The pattern is repeating. The only question is timings. And based on history, the window is closing fast. Buffett has said it himself. Quote, "I don't know if the market will crash tomorrow or in 2 years, but I do know that prices are pricing in way too much optimism, and I don't pay for optimism. The math says this market is living on borrowed time. Here's the choice. Follow the crowd and hope this time is different, or follow the guy who's been right 10 times in a row." Buffett has already moved $344 billion in cash. He's not guessing, he's calculating, and the math says time is running out. What are you going to do?